You're sitting in your car in the bank parking lot and you just got a text. Insufficient funds, $34 for a $6 coffee, and what's wild is you had the money. It just hadn't settled yet, whatever that means, because the bank decided to process your debit card purchase before your direct deposit, even though the direct deposit hit your account 2 hours earlier in the day. You stare at your phone, you feel that specific kind of rage that only shows up when you know you're being taken advantage of, but you can't quite prove it, and then you do what everyone does. You pay it, you move on, you forget about it by Friday. Here's the question nobody asks in that moment. Was that an accident, or was that the plan? Most people think of their bank the way they think of a parking garage. It's just a place you put your car, or in this case your money, and you assume the only thing the building wants from you is to keep paying the monthly fee for the spot. Neutral, boring. Background infrastructure, but that's not actually what a bank is. A bank is a business, and like every business, it has a number it's trying to grow every single quarter, and that number does not grow because you're financially comfortable. It grows because of very specific behaviors, very specific moments of friction, and very specific design choices that most people never notice because they're not supposed to notice them. And once you understand what those moments actually are, you start seeing your own bank account completely differently. Some of it is going to make you angry. Some of it is honestly kind of brilliant, in the same way a magic trick is brilliant once you know how it works. I'm Mara, and I spend an unreasonable amount of time pulling apart how financial systems are actually built, not how they're marketed, because there's almost always a gap between the two. If you've ever wondered why your savings account pays you basically nothing while your credit card charges you a small fortune, stick around, because that's not a coincidence either. And by the end of this, you're going to look at your banking app like you're seeing it for the first time. Let's start with the overdraft fee, because that's the most obvious one, even though most people still don't understand how it actually works. Picture your checking account like a single-lane bridge. Transactions are cars trying to cross. In real life, those cars arrive in whatever order you actually made the purchases. You bought gas in the morning, groceries at lunch, and a streaming subscription renewed at midnight. Simple enough, but banks don't always process transactions in the order they happened. For years, many of them process transactions largest to smallest instead, and that single decision is not random. If you have 5 small purchases and 1 big one, and there's only enough money for some of them, processing the big one first can cause every single small purchase behind it to bounce. Instead of 1 overdraft fee, you get 5. Same balance, same purchases, completely different outcome, just based on the order they got sorted. Multiple banks have actually been sued over this exact practice and quietly settled, which tells you everything you need to know about whether it was an innocent system quirk or a revenue strategy. Now here's where people usually think they understand the problem, but they only understand half of it. The fee itself isn't even the real issue. The real issue is the thing sitting right next to it on your account settings, the thing called overdraft protection or overdraft coverage, depending on which bank you're with. Notice the language: protection, coverage. These are words that make declining a purchase sound like the dangerous option and approving an overdraft sound like the safe one. In reality, it's the opposite. If your card gets declined at the register, you're mildly embarrassed for 10 seconds and you go to an ATM. If the bank lets the purchase go through anyway, you've just paid $34 to buy a $6 coffee. The bank is letting your purchase succeed specifically because the failure mode is more profitable for them than the success mode would be for a normal merchant. They're not protecting you from anything. They're selling you a very small, very expensive loan and calling it a courtesy. And the part that should genuinely bother you is that for a long time, this was opt-out instead of opt-in for debit transactions. Meaning the default setting on a brand new account was already working against the customer before they touched a single button. Regulations eventually forced this to flip for most new accounts, so people have to actively choose to enroll, but a staggering number of existing accounts were grandfathered in under the old rules. And a lot of people have simply never gone back to check which version they're on. Which means right now there's a real chance you're carrying a setting you never consciously agreed to. So that's friction point number 1. But it's almost a beginner move compared to what happens with interest rates, because this is the one that doesn't even require you to make a mistake. This one just requires you to do nothing. Think about the relationship your bank has with your money on two different sides of the same desk. On one side, you deposit cash into a savings account, and the bank pays you interest for the privilege of holding it. On the other side, you carry a balance on a credit card, and the bank charges you interest for the privilege of lending it to you. Same institution, same dollar, two wildly different prices depending on which direction it's flowing. At a typical large national bank, your savings account might be paying you something like a fraction of a percent annually. Meanwhile, the average credit card sitting in your wallet is charging north of 20%. That gap, that enormous canyon between what they pay you and what they charge you, is not a side effect of running a bank. It is the business model of running a bank. Here's the part that makes this so effective as a system. They're not relying on you noticing the gap. They're relying on you never checking. The average person opens their banking app to see if a paycheck cleared or if they can afford dinner out this weekend. Almost nobody opens it to compare their own savings APY against what's actually available elsewhere, because checking interest rates feels like a chore reserved for people who enjoy spreadsheets. So the money just sits there year after year, quietly earning almost nothing, while that same bank takes deposits like yours and lends them out, invests them, or uses them to back other products, earning a return that's a multiple of what they're paying you for the privilege. This is where I want to flag the objection a lot of you are probably already forming, because it's a fair one. You might be thinking, sure, but interest rates on savings accounts are low everywhere right now. That's just the economy, not some scheme. And that's partially true. Rates do move with broader economic conditions, but here's the detail that breaks that excuse completely. During the exact same period where a major national bank is paying you a fraction of a percent, an online bank with no physical branches, lower overhead, and the same federal protections is often paying 10, 20, sometimes 30 times more on the same type of account. Same safety, same insurance, wildly different payout. If it were purely about the economy, every bank would be roughly the same. It isn't about the economy. It's about which banks are betting that you won't move your money, and which banks are trying to win your business by actually competing for it. That inertia, that simple unwillingness to switch accounts, is worth an enormous amount of money to the banking industry every single year. And almost none of it shows up as a single dramatic fee you'd notice. It shows up as the absence of money you never realized you were entitled to. Now let's talk about something that sounds almost too small to matter, and that's exactly why it works so well. The minimum balance requirement. A lot of checking and savings accounts are marketed as free, no monthly fee, sounds great, sign here, but buried in the fine print is usually a condition. Keep a minimum balance of some specific number, maintain a certain number of monthly direct deposits, or that free account suddenly costs $10, $15, sometimes $25 a month. Here's the part that's almost diabolical when you think about who this actually targets. The people most likely to dip below a minimum balance requirement are, by definition, the people who have the least amount of financial cushion. Meaning the fee structure is mathematically designed to extract the most money from the customers who can least afford to pay it, while customers who already have plenty of money sitting around never trigger the fee at all. It's not that wealthier customers are smarter about avoiding it, it's that the entire mechanism was never built to catch them in the first place. This connects to something I think is actually the most underrated trick in the entire system, and it's not a fee at all. It's the design of the checking account itself. A checking account is built to be liquid. Easy in, easy out, debit card right there in your pocket, frictionless. That sounds like a feature, and for spending money day to day, it is. But that same frictionlessness is precisely what makes checking accounts terrible vehicles for actually building savings. There is no psychological speed bump. The money that sits in your checking account is one tap away from a purchase you'll forget about by next week. Compare that to money sitting in a separate, harder to access savings account, ideally at a completely different bank than the one you do your everyday spending with. Suddenly there's friction. You have to log into a different app, initiate a transfer, wait a day or two for it to land, and in that gap, a huge percentage of impulse purchases simply die on their own. Banks know this. It's why so much of the industry's product design pushes you toward keeping the bulk of your money in the easiest, most liquid, lowest yielding account possible. Marketed under the comforting language of convenience, when convenience for you in the moment is often the opposite of convenience for your future self. You might be thinking, okay, but credit unions are supposed to be the ethical alternative here. They're member-owned, not shareholder-owned, so doesn't that solve the whole problem? Partially. Credit unions generally do offer better rates and lower fees on average, because their profits get returned to members instead of outside shareholders. So structurally, there's less incentive to squeeze you. But they're not magically immune to every mechanism we've talked about. Overdraft fees still exist at credit unions. Minimum balance requirements still exist at credit unions. The incentive is gentler, not absent, so credit unions are often a meaningfully better option, but switching to one isn't a finish line where you can stop paying attention. It's a better starting position in the same game. Let's talk about one more mechanism, because this is the one that quietly affects almost everyone, and very few people ever connect it back to their bank specifically. And that's the rewards gap between debit and credit. If you use a debit card for everyday purchases, you typically get nothing back. No cash back, no points, no anything, because debit transactions cost merchants less in processing fees, which means there's a smaller pool of money for the bank to share with you as a reward. Credit card transactions cost merchants significantly more in processing fees, and a slice of that gets funneled back to you as rewards, specifically to incentivize you to use the more expensive payment method instead of the cheaper one. On the surface, this looks like the bank being generous with credit cards and stingy with debit cards. Underneath, it's the bank steering you toward the product that, if you ever carry a balance even once, generates the kind of interest income we talked about earlier. The rewards aren't charity. They're the cost of acquisition for a much larger potential profit center. This is exactly the point in the conversation where people tend to overcorrect, and I want to address that directly because I see it constantly. Someone learns all of this, gets understandably furious, and decides the solution is to distrust the entire banking system. They close their accounts, they start keeping large amounts of cash at home, they avoid credit entirely even when used responsibly. Or they chase whatever flashy alternative promises to beat the banks, without federal insurance or any real regulatory protection behind it. That instinct is understandable, but it trades a manageable, well-understood set of fees for a much larger, much less visible set of risks. Cash sitting in a drawer doesn't earn interest, doesn't grow, and isn't protected if something happens to your home. None of what we've covered today is an argument for abandoning the system. It's an argument for stopping being a passive participant inside it, because here's the thing that actually matters once you see all of this clearly. None of these mechanisms require you to be reckless to get caught by them. They require you to be busy. They require you to be the kind of person who doesn't have time to compare savings rates across 6 different banks, who doesn't read the fine print on overdraft settings, who keeps a checking account because that's just where the paycheck has always gone. The entire system is optimized to extract value from inattention, not from incompetence. Which is actually good news because inattention is fixable in an afternoon, while incompetence would take years to undo. So what does fixing it actually look like in practice? It's not complicated, and it's definitely not a personality overhaul. You check your current overdraft settings and switch to decline instead of allow if that option exists for you. You compare your savings account rate against 2 or 3 online banks just to see how big the gap actually is. Because seeing the real number in front of you is far more motivating than hearing a statistic. You separate your spending money from your saving money into accounts at different institutions, specifically to reintroduce a little bit of friction. And you stop assuming that the path of least resistance your bank has laid out for you is the same as the path that's actually best for your money. Because those 2 paths were never designed to be the same path. They just look similar enough that almost nobody checks. The unsettling truth is that your bank isn't your enemy exactly, but it isn't your ally either. It's a business with a number it needs to hit, and for a long time, the easiest way to hit that number was to count on you not paying close attention. That stops working the moment you actually look. And once you've looked, you genuinely can't go back to not seeing it.